it's a certainty that there will be a failure to deliver. I mean, you're talking about triple digit silver, maybe a fair sized number in front of it. $400, $500, $600, who knows? Price of silver has been suppressed for so many years with naked paper contracts, and the game just kept going and going. It could have easily been blown up by Russia, could have easily been blown up by China, but that would be an act of war. And they basically left us to our own methods of destruction, of destroying ourselves. And that failure to deliver is going to happen. When that happens, it's going to set a time bomb of derivatives defaulting off. I mean, that will be the end of the financialization of the West.
When Bill Holter says it's a certainty that silver will experience a failure to deliver, the world should listen. What he's talking about isn't just another market correction or speculative bubble. He's describing the implosion of a decades-long financial con. A system built on naked paper contracts and hollow promises is on the brink of collapse, and when it goes, we're not looking at $50 or even $100 silver. We're looking at triple digits with a 4, 5, or even 6 in front of it. The Western financial system has long manipulated the price of silver to maintain the illusion of stability. Wall Street giants like JPMorgan and Citigroup, propped up by the CME and the Treasury, have sold mountains of silver they never owned. Paper promises backed by nothing. This con game has continued only because nations like Russia and China have chosen not to pull the plug. But now, the West is being allowed to self-destruct. Holter warns that a cascading failure in silver will trigger a derivatives meltdown, a time bomb buried deep within the structure of Western markets. If that bomb goes off, it won't just take down silver shorts. It will obliterate confidence in paper assets across the board, the death of financialization, and a forced return to real, tangible value. For gold and silver holders, this is the signal. The final chapter of Wall Street's manipulation script is being written in real time, and physical metals, not promises, will be the only safe haven left. If you're still on the sidelines, now's the time to move. Make sure to like, subscribe, and stick around as we dig deeper into Holter's stunning predictions, and how it all ties into war, oil, and the next stage of global chaos. We appreciate the support and hope you enjoy the video.
What are your current thoughts on the gold market and how all of this geopolitical turmoil could potentially affect it?
Well, the price of gold has gone higher from an institutional standpoint. You've got institutional buying, you've got hedge fund buying. Most importantly, you have central bank around the world buying. Oddly, and I mean, you couldn't have told me this scenario 2 years ago, 5, 10, 20 years ago, that the world would be on the verge of World War III and the public would be selling gold. They're selling gold, they're selling silver. And I've seen more sales in the last 6 to 9 months, just in my own personal book, in the last 9 months, I've seen more selling than I've seen collectively in the last 15 years. That tells me that there's no money on the streets. That tells me people, the average person, is running low on funds and selling assets. And of course, you know, what asset are you going to sell? Something that doubled or something that's down in value? So you've seen gold, you've seen silver from a retail standpoint has been sold to raise capital, but from a central bank standpoint, they're unloading it left and right. It seems to me that, I mean, obviously paying the debt back is mathematically not possible. There's no way you can pay the debt back in current dollars. And I said all along that there would be a point in time where they would kick the table over. And they kick the table over because they know that they can't hold the system up any longer. So they start a war, some type of false flag, whatever. They kick the table over and they say, well, our policies were sound, our policies were working, except for, you know, this or that or whatever. And they'll have something to point at, to blame, rather than the structure of the system. People don't wake up until it affects them personally. I mean, if people woke up and in a week's time realized they've got 25% less capital than they had the week before, that affects them. They go into the grocery store and there's no cans of tuna fish to buy. That affects them. Uh, we have a real estate. We've already had commercial real estate has already begun a humongous collapse. Not so in the housing market. The housing market, the only thing that's happened is the volume is dried up. The volume now is about 50% of what it was a couple of years ago as far as sales, as far as closings. The next thing will be price drops. That affects people mentally. And it affects them financially, but more so mentally. If you think your house is worth 2/3 or 3/4 of what it was. So my answer to that is basically no, nobody's going to wake up until it affects them personally.
How do you currently view the setup for silver, and what are the catalysts that could potentially take us back to all-time highs and potentially beyond? I mean, if we even go back to 2011 to get back to that level, we'd need to be in triple-digit silver here.
Yeah, there's all kinds of potential events. I think the event or the response to events is that we see a failure to deliver, because there's so many paper contracts out there per real deliverable ounce that it's a certainty that there will be a failure to deliver. That failure to deliver, I mean, you're talking about triple digit silver with maybe a fair sized number in front of it. $400, $500, $600, who knows? You just have to understand that the price of silver has been suppressed for so many years with naked paper contracts, and the game just kept going and going. It could have easily been blown up by Russia, could have easily been blown up by China, but that would be an act of war. And they basically left us to our own methods of destruction, of destroying ourselves. And that failure to deliver is going to happen. And when that happens, it's going to set a time bomb of derivatives defaulting off. I mean, that will be the end of the financialization of the West.
What would that mean for precious metals prices, both gold and silver?
Oh, I mean, you can't forecast a price if there's no supply. I mean, it will end in a failure to deliver. And look at the price of gold, look at the price of silver, much, much higher than they were 6 months, a year ago. And all of those shorts are underwater now. All the shorts in silver are underwater. All the shorts in gold are underwater, which means they've got to be meeting margin calls. And okay, so the money gets printed up and maybe even lent to the shorts, but it's not going to make any difference, because at some point in time, the herd will move in unison and say, I want my metal. I don't trust a paper contract. My late partner, Jim Sinclair, used to always say, what is the value of a contract that cannot perform? And the answer is zero. And if you're zeroing out contracts, I mean, he was talking about, you could see COMEX gold, $10 offered, $10 offered, no bids. And you could see it in the cash market, $50,000 bid and no offers. And that illustrates the value of a contract that cannot perform. It's worth zero. But that's going to bleed over to the entire derivatives complex. I mean, what does that mean for oil contracts? What does that mean for rice? What does that mean for wheat, orange juice, et cetera, et cetera? It's going to push the world more or backwards toward cash and carry trade, as opposed to the financialization where paper contracts can push the price of an asset around to fit whatever the current narrative is.
While silver's detonation may come from the financial side, the fuse may very well be lit in the Middle East. The situation between Israel, Iran, and the U.S. is spiraling toward a confrontation that feels less like geopolitical posturing and more like the opening chapter of a global war. Holter describes the timing of Israel's attack, just before scheduled peace talks, as a Pearl Harbor moment. It's a provocation aimed at forcing hands and escalating tensions. And make no mistake, the United States isn't just a bystander here. Military assets are already repositioned, oil tankers are ablaze in the Strait of Hormuz, and Washington's narrative is shifting fast, from diplomacy to drums of war. Holter doesn't rule out a false flag, and history gives us no reason to doubt that possibility. In fact, he places the probability near 100%. Why now? Liquidity is drying up. The debt is mathematically unpayable. The system is crumbling, and when cornered, empires create distractions. Wars, real or manufactured, have always been a tool to reset economic chaos and reassert dominance. But this time, the cost might be far higher. A wider conflict could see oil soar past $300, currencies collapse, and treasuries dumped. And in that chaos, guess what doesn't default? Gold, silver, real assets. So when Holter says the game is ending, he's not speaking in hypotheticals. This is what the final unraveling looks like. And the last domino standing might be whether the public finally realizes that the real enemy isn't some distant regime, but the corrupt system they've been sold as safe for decades.
First off, it was the attack was done, a day or 2 days before Sunday's scheduled peace talks. So from that standpoint, you could look at it as a Pearl Harbor. If you look at, you got to look at the reasoning behind what's happened. Iran was on the list, and this list goes back to the year 2000, 2001, where they had, I forget all of them. I think it was Yemen, Iraq, Iran, Syria, Libya. That was a hit list, and Iran is, one of the remaining on the hit list. You could also look at it from the standpoint of liquidity's getting tight, and historically, the way to ramp up an economy is to go to war. So, now you've got the military-industrial complex is going to be fed again. Do I think the U.S. is going to join in this? I certainly hope we do not. But it looks pretty imminent. I mean, what did we do? We've sent refueling aircraft to that region. We're relocating naval assets. To me, it looks like the U.S. will join. You'd have to be actually in the backroom discussions to know whether or not Israel acted on their own or not. My biggest concern is that Russia jumps into this, and understand that Iran is a major supplier of oil to China. And they've just signed a bunch of, over the last year, they've signed a whole bunch of trade deals guaranteeing them X amount of oil. Is that oil going to even be produced after the smoke clears? So, I mean, the danger is that Russia gets involved, China gets involved. You're talking about a world war.
Normally, when oil prices rise on these sorts of headlines, wars, geopolitical news, it tends to drop back down again. Do you think this time could be different and we might see a more sustained rise in the oil price if this conflict continues?
Well, yeah, as of this morning, it's different. We've already had 2 tankers in the Strait of Hormuz that collided. You've got one that's on fire. I don't know the likelihood of it sinking, but obviously that would be an ecological disaster. But if you start plugging up the Strait of Hormuz and that's not able to be used, that's 20% of all the oil that's transported worldwide. So, I mean, that's, you're putting a crimp in supply right there. I mean, if this does go hot, it's already hot, but if the U.S. does join in, if Russia follows, if China follows, I've seen numbers of $130 oil. I think it's plausible you could see $300 oil depending upon, what happens to the infrastructure of Iran producing oil. Does anything even, would anything flow through the Strait of Hormuz? Probably not. So you really can't put a number on where oil is going to go. But like I said, if we see this expand into a worldwide conflict, the price of oil is going to go stratospheric. I would just say that the first casualty of war is truth. And I just posted last night that they did not have intelligence that Iran was close to a nuclear weapon or even trying to build nuclear weapons. So, who's telling the truth? Was she lying? Was she, ill-informed? I don't know, but I think it's pretty convenient to come out and say that, Iran's just a few days away from a nuclear weapon and Israel launches.
Yeah, and Benjamin Netanyahu has been accusing Iran of being about to build a nuclear weapon for a very long time. I think it's back to the 90s. So that this does not seem a super plausible reason to be attacking the country. I wonder what your opinion is on the potential of a false flag being instigated to get the American people behind the war.
Yeah, I do. And I think the answer to your question is probably 99.9% chance that there is a false flag somewhere. I mean, obviously, there's a chance that that doesn't happen. But I think it's extremely likely that it will happen. And I can almost guarantee you that the false flag will not be a carrier going down. Can you imagine what markets would do? Can you imagine what the dollar would do if it was shown that the U.S. is not the biggest, baddest bully on the block any longer?
Yeah, that's an interesting point.
Let me add to that. I mentioned the dollar. Let's look at treasuries. What happens to treasury auctions? Do you have the safe haven flight of capital coming to the U.S. or going somewhere else? And that somewhere else most likely would be gold and silver or other hard assets. Under the scenario of a carrier going down, the treasury market would be in total convulsions. The dollar would probably take a 5% hit. I don't see that scenario happening, but nothing's off the table.
Holter's thesis that a failure to deliver in the silver market will spark a cascading crisis across the entire derivatives complex is not just theory. It's a logical projection supported by mounting data. As of mid-2025, estimates suggest that for every ounce of physical silver available for delivery on COMEX, there are between 200 and 300 paper claims, a leverage ratio that is historically unsustainable. With open interest levels rising while registered inventory continues to decline. At the same time, the short positions held by commercial banks and managed money in both gold and silver are now significantly underwater. With gold stabilizing above $3,350 and silver trading around $36, many of these leveraged trades, initially placed when prices were lower, are triggering aggressive margin calls. This has created acute liquidity stress within a derivatives market already under pressure from geopolitical risk and bond market volatility. Meanwhile, central banks globally have acquired over 1,200 tons of gold in the last 12 months, marking the highest net purchases since the 1960s. In stark contrast, retail investors in the US and Europe have been net sellers of bullion and coins, largely due to financial strain, an unprecedented divergence between institutional accumulation and public capitulation. On the geopolitical front, a widening conflict in the Middle East, particularly involving the Strait of Hormuz, would disrupt up to 20% of global oil flows. Analysts at JPMorgan and Barclays have floated scenarios where oil breaches $150 to $200 per barrel if military escalation persists. A blockade or infrastructure strike could push that even higher, creating sustained inflationary pressure and global energy shortages. These stressors all converge on one point: trust in paper markets. Holter's argument that a contract which cannot deliver is effectively worthless echoes the foundational principle of risk management. Once the market collectively demands physical settlement over synthetic exposure, and those demands cannot be met, the entire edifice begins to unravel. This would not be confined to precious metals. The repricing would extend to agricultural futures, energy contracts, and even sovereign debt. In such a scenario, the flight to safety would bypass financial institutions and move directly into real, non-rehypothecated assets, especially gold and silver. The window to reposition before this shift fully materializes is narrowing. Holter is not forecasting a gradual transition, but a sharp break, a discontinuity in market function. Those still holding faith in paper claims will likely find themselves locked out when convertibility collapses. In a world where liquidity vanishes and promises fail, only possession will matter. And in that world, physical metals will not just preserve wealth, they may define it. If you understand the implications of what Bill Holter is saying, now is not the time for complacency. This isn't just a market correction, it's the unraveling of a system built on leverage, illusion, and trust that's quickly evaporating. Start taking steps to secure real assets before the markets reprice reality. Stay informed, think critically, and position yourself on the right side of this historic transition. If you found this analysis valuable, consider subscribing for more interviews and breakdowns that cut through the noise. And share this with someone who still believes paper promises are as good as the metal itself. Thanks for tuning in, and see you in the next one.